This just broke. One of the biggest buyers of Nvidia GPUs on the planet is reportedly exploring a business where it sells AI compute to everyone else. I'm talking about Meta. The same Meta that has been buying chips, locking up data center capacity, and helping create the belief that AI compute would stay scarce forever. Now, according to recent reports, Meta may rent out some of that AI capacity to outside customers. That is not a small side business. That is a signal. Because when one of the biggest buyers in the market starts acting like a seller, every pricing model in the AI infrastructure trade has to be rechecked. Meta stock jumped close to 10% after the report. CoreWeave and Nebius sold off hard because Meta may have just gone from being one of their most important customers to potentially becoming one of their most dangerous competitors. My name is Phoebe, and you're watching TradingKey. Today, we are walking through Meta's cloud pivot, what it reveals about the real state of AI demand, why it is a serious problem for the compute rental business, and what it means for the chip trade going forward. Quick note before we dive in. This is not an AI is over video, but the easy scarcity trade that powered the last 2 years, that story is getting a lot more complicated. The scorecard nobody wants to see. To understand why Meta may be doing this, you need to look at the actual numbers, and they are genuinely uncomfortable. In 2025, Meta brought in about $200.9 billion in revenue. Capital expenditure came in around $72.2 billion. That is about 36 cents of every revenue dollar going into hardware before anything else gets paid. In Q1 2026 alone, Meta spent $19.8 billion on infrastructure in a single 3-month window. Then it raised full-year CapEx guidance to a range of $125 to $145 billion. Take the midpoint, $135 billion for the full year. Compare that to $72.2 billion last year. That is roughly 87% growth in capital spending, year over year. For context, Microsoft is guiding around $190 billion. Alphabet, $180 to $190 billion. Amazon, roughly $200 billion. Meta at $135 billion is the smallest of the 4 hyperscaler CapEx monsters, but it has lapped almost every other tech company on Earth by a margin that is not even close. If you spend like that, you need the AI results to show for it. Meta's advertising business is still exceptional. In Q1 2026, ad revenue grew 33% year over year. The AI running Meta's recommendation and targeting systems is clearly doing its job. No argument there. But strip out advertising. Look at Meta purely as a standalone AI product company competing against OpenAI and Google. Different story. According to Sensor Tower data for Q2 2026, ChatGPT had around 1 billion monthly active users. Google Gemini had about 472 million. DeepSeek had around 68 million. Meta's standalone AI app, around 61 million. Meta will say Meta AI has about 1 billion monthly users across platforms, but the AI entry point is baked into Facebook, Instagram, WhatsApp, and Messenger. It is there whether you went looking for it or not. That is distribution. It is not necessarily intent. Here is the number that puts it all in perspective. The company spending $135 billion a year on AI infrastructure has 3.1% of the standalone AI app market. That gap is why the cloud announcement makes sense. If your AI products cannot absorb all the compute you bought, you find someone who will pay you to use it. That is smart, but it also tells you something. If every GPU Meta owned were truly essential to the internal AI roadmap right now, Meta would probably keep them. It would not be exploring a way to rent them out. What the chip trade has to reprice. For the past 2 years, the AI hardware trade ran on one simple story. Compute is scarce. Hyperscalers need everything they can get. Nvidia sells every GPU it makes. HBM memory stays tight. Optical networking, servers, and cooling systems all ride the same wave. When buyers are that desperate, suppliers run the negotiation. Customers sign long-term contracts at premium prices. They buy early because they are terrified capacity will disappear. That is how a real shortage market works. Meta's reported cloud pivot hits that psychology directly. The issue is not that Nvidia stops shipping servers tomorrow. The deeper issue is pricing power and what happens when the buyer mindset changes. Until now, Meta's posture has basically been, give us the product, we will sort out the price later. But the moment Meta starts analyzing utilization rates and calculating what it can charge external customers for idle compute, the posture changes. Now it becomes, we have breathing room. Let us push back on price. Let us make every GPU justify itself. That shift alone is worth billions in supplier margin. Not because demand disappears, because the fear driving the premium starts to fade. Semiconductor stocks do not need demand to collapse to fall hard. They just need the market to stop believing in permanent shortage. That is what is getting priced right now, from customer to competitor. The companies most directly in the crossfire are the neoclouds, CoreWeave, Nebius. Their whole model depends on scarcity. They build GPU clusters, sign long-term contracts, and rent compute to AI labs and startups who cannot get enough from the major clouds. Meta was not just another buyer. It was an anchor customer. Look at Nebius. In March 2026, Nebius announced a 5-year deal with Meta worth up to $27 billion, $12 billion in dedicated locked capacity, another $15 billion in flexible deployment. The structure was even designed so Nebius could sell excess capacity to third parties at a premium. If it could not sell it, Meta would absorb it. At the time, that looked like the perfect backstop arrangement. And now the backstop is building a competing product. The pricing math makes this genuinely dangerous. CoreWeave and Nebius have to price compute to cover GPU depreciation, interest on leveraged balance sheets, power costs, and shareholder returns. Multiple cost layers under every contract. Meta's math is completely different. Meta already bought the hardware. That money is spent, it is a sunk cost. Any external revenue that covers incremental electricity and a slice of depreciation is pure upside. They can price more aggressively than any pure-play compute renter and still come out ahead. If developers start believing they can get cheaper compute from Meta in a few months, they stop signing expensive long-term contracts with CoreWeave and Nebius today. That hits backlogs. That hits financing assumptions. That hits the entire business model. What is real and what is foam? To make sense of where this goes, you need a better framework for AI demand. Because not all AI demand is the same. Think of it in 3 buckets. The first is genuine demand. Someone paying for AI because the value they get back is obvious and measurable. Code generation is the clearest live example. Software engineers are expensive. When an AI tool reliably cuts development time, companies can do that math easily. They pay, and they keep paying. Anthropic's Claude Code data gives us a useful window. Data from 235,000 users across 400,000 sessions shows heavy users averaged about 20 hours per week on the tool, with AI handling roughly 80% of code writing and testing. That usage survives budget review, and it showed up in Anthropic's financials. The company is projecting Q 2026 revenue of $10.9 billion with $559 million in operating income. A company carrying enormous compute costs crossing into profitability. That is what genuine demand looks like. The second bucket is subsidized demand, usage that exists because AI companies are pricing below true cost to grab market share. It can look massive, but it has not been stress tested by real pricing. Some converts into genuine demand when costs fall enough. Some disappears when the subsidy does. The third bucket is phantom demand, infrastructure spending driven by competitive anxiety rather than actual revenue requirements today. The "we cannot afford to be left behind" purchases. Individually, for one company, that can be rational. But when the whole industry does it simultaneously, you get overbuilding. And that is what Meta's move is really revealing. The 3.1% standalone AI app market share against $135 billion in annual capex tells you exactly what the mismatch looks like. Meta converting idle hardware into a rental business is an honest accounting of what phantom demand looks like when it comes due. Why cheaper compute is actually good news? Here is where the story flips. Cheaper compute is bad for hardware margins in the short run, but it is usually very good for AI adoption over time. ARK Invest's 2026 analysis shows AI training costs are dropping 75% every single year. Not per decade, per year. Inference costs are falling even faster. Pure algorithmic improvement alone is driving roughly a 3 times annual cost reduction. That is not a slow trend. That is a cliff. Every AI use case that looked too expensive 18 months ago may now be moving toward break-even. Real-time translation, medical tools for smaller healthcare systems, legal automation, enterprise agents running full business processes. All of these have a price point where they flip from burning money to making money, and that price point keeps moving closer. One more thing worth saying. Right now, most AI coding usage comes from professional developers. But when non-technical professionals use these tools, lawyers, financial analysts, salespeople, the performance gap can be surprisingly small. If the AI can turn a lawyer's plain English workflow description into working automation, the addressable market is not just 30 million professional developers. It is hundreds of millions of knowledge workers with deep domain expertise and no programming background. Falling compute costs are what unlock that. So, Meta flooding the market with lower cost supply is painful for hardware vendors, but it may help the application layer mature faster than it otherwise would. Near-term pain for the infrastructure trade, longer-term fuel for real adoption. Pain first, then opportunity. Near-term, the risk is real. The narrative that justified premium valuations across the semiconductor supply chain was built on one belief: permanent scarcity. That belief is now being tested. The most exposed names are the ones priced purely on shortage, highly leveraged compute rental operators, marginal hardware suppliers, anything where the entire thesis is there will never be enough compute. Those companies face revenue pressure and multiple compression at the same time. For the core infrastructure names, the story is more nuanced. Nvidia, TSMC, SK Hynix, and Micron still sit at the center of a real long-term AI cycle. But even great companies can correct sharply when the market shifts from panic buying to return on investment discipline. That is a normal part of technology cycles, not the end of the cycle. The opportunity for long-term investors usually appears when good companies get sold alongside bad companies in the same indiscriminate wave. But selectivity matters now more than it has in 2 years. The better question is not whether AI demand exists. It does. The better question is what kind of demand you are buying. Real demand backed by measurable returns. Subsidized demand waiting for costs to fall. Or phantom demand pulled forward by fear. That one question will define a lot of the next phase of this trade. The end of easy scarcity. Here's where I land. Meta's cloud pivot is not just a new product idea. It is a signal. For Meta, it is a smart way to generate returns on infrastructure not yet fully utilized internally. For the neoclouds, it is a direct competitive threat from a company that does not have to play by the same pricing rules. For the semiconductor supply chain, it challenges the idea that AI compute will stay permanently scarce at permanently premium prices. And for the broader AI ecosystem, it might actually be healthy. Cheaper compute means more builders can enter. More genuine use cases cross the profitability line. The speculative demand gets squeezed out, and what is left is more durable. Technology cycles go through booms, resets, and then broader adoption. We may be entering a reset. That does not mean you sell everything. It means you get more selective about what you hold and why. So if chip stocks get volatile from here, ask a better question than whether AI is dead. Ask whether the market is selling the bubble or giving you a better price on the real winners. That is where the opportunity is. What do you think? Is Meta's move a real warning sign for Nvidia and the compute rental companies? Or just a smart way to monetize hardware it bought early? Drop your answer in the comments. I read all of them. I'm Phoebe with TradingKey. Subscribe for more breakdowns like this. See you in the next one.